My name is Scott Stevenson. I'm Senior Vice President with BAFT, the Bankers Association for Finance and Trade. We provide unmatched advocacy, thought leadership, education and training, and a global forum for international transaction banking across the industry. We have over 300 members distributed on a global platform. So thank you for attending today's session. We have an illustrious cast with us today. Mr. Andre Castleman, Chairman of FinTech Committee of ITFA, Mr. Michael Hogan, who kindly agreed to host today's conference. He's Managing Director with Monetigo. Mr. Levent Kudlika, Managing Director, Head of Fraud Risk at HSBC, based in the late hour, and Mr. Peter Mulroy, Secretary General of Factors Chain International, who's coming to us live from Uganda today. So thank you for that effort. I have a couple of housekeeping items I'd like to go through quickly. First, on how to navigate BAFT Connect. At the tables that you're located, you can actually double click on another table and move to another table. There's also a number of different floors. If you see on the left-hand side, it says floor. That's in effect an elevator. You can click on those dots, those boxes, and move to another floor as we reach capacity. We're expecting a little bit over 100 or so people here today. At the end of the live session, we'll go to a roundtable discussion whereby our panelists will join the audience at the various tables. And those tables will be table 1, 2, and 7. But we're going to invite everyone to remain and network at the various tables and then move in. Each table has a capacity of 8 people. So as people are able to pose questions to our panelists, if you could then move on to another table and continue your network experience. I wanted to say that there's a chat whereby you can leave messages either for the audience at large or for individuals, and that's in the navigation toolbar. As well, if there's tech support that's necessary, look for the BAFT avatar, and BAFT staff will assist you. On the right-hand billboard, there are helpful tips, and left billboard there's a how-to video. Just before we go, I failed to mention that there is a section whereby where it says Q&A, and that is where your questions can be posed, and then they'll be fed to the panelists. So my apologies for skipping that. I'd now like to introduce Mr. Peter Mulroy, Secretary General of Factors Chain International, to discuss about materiality and the impact of trade fraud. Peter?
Thank you so much. A great pleasure to be here at this BAFT event together with my colleagues. Yes, this is such a intense and heartfelt experience, or something that our industry always is extremely cautious of. One of the greatest risks relating to the receivables finance industry in general, and trade in particular. I wanted just to kind of give just talk a few minutes about the general effect of fraud in our industry. And as you know, the industry is divided into 2 parts, secured and unsecured. And of course, the receivables finance industry is predominantly focused in the secured area, relating to the receivables that are assigned or pledged under like an asset-based transaction. Those receivables, in essence, protect the financier, the factor, the bank from any type of loss, unless those receivables are fraudulent. But I will get into that first with this first slide, and that is the fraud triangle. The fraud triangle is a theory that was developed by a gentleman by the name of Donald Cressy. And it really just talks about three areas. Basically, in any type of fraud scenario, you have to have the opportunity to defraud the institution. And those opportunities can fall into two categories: circumstantial and premeditated. Circumstantial is an example where a company, a legitimate company that a bank or financial institution, a factor approaches to finance their receivables in this example. And basically, legitimate business, seller producing product or service, selling to various buyers. And let's say there is some type of an event, an external event that, like a COVID, like a pandemic, or some other external event that causes the entity to have financial duress. The second is internal, some type of an internal event that causes as well some type of duress. But it's based on the circumstances, whether they be internal or external, that causes the company to kind of unincidentally cause some type of fraudulent activity. It could be as simple as they have a legitimate shipment. They know it's coming. They create an invoice to basically get funding early, knowing that purchase order is coming, or knowing that the purchase order has been issued, but they're just deciding to deliver early. But that's falsified documentation, as an example. The flip side is premeditated, and that's typically involving a criminal, whereby an individual creates a fake company, and potentially fake buyers in a factoring or receivables finance scenario, and that seller basically pretends that they are a legitimate business. Maybe there was some legitimacy to that individual or those managers beforehand, but the company was set up to defraud the financier. And that is a premeditated attempt. So you have to have the opportunity, especially in circumstantial, you have to have the pressure, the financial pressure to cause that fraud. And there has to be some rationalization. Typically under circumstantial, the rationalization is everything will be okay. We know we're going to get paid. We know the buyer's going to pay us. And this typically turns into a snowball effect normally. If you go to the next slide, and basically just wanted to kind of highlight, in any type of industry that you're financing, and especially in receivables, you never catch, and especially if it's premeditated, you never catch it from the very beginning. But you can certainly do your due diligence and prepare yourselves prior to the onboarding of that client and that client's customers. But there's a lot of, let's say, preparation to look for, and you can basically finance, looking at those key vulnerabilities, you can finance a company, but that potentially that company could be producing fake invoices, or they could be producing invoices that are, dated incorrectly, meaning, again, in that scenario that I talked about before, it isn't a legitimate sale yet. So they're creating the invoice, but they know the goods are coming, the goods will be produced and sold, so they will date it outward. Maybe the normal terms is 60, but then you have a invoice of 180-day terms, for example. That's unusual. So there's lots of different ways to spot this, and it's one of the things that the FCI Academy teaches. We have just a course particularly dedicated to the rise of fraud. You could have multiple invoicing. And another example is over invoicing. So let's say the order is for 100,000, but they decide to add another 50,000 to the order, even though that it's illegitimate. At the end of the day, the process is you have to prepare yourself on the pre-onboarding and then the post-onboarding. But I think we're going to have some questions about that a little later, and I'll address those onboarding issues then. Thank you.
Thank you, Peter. Our next speaker is Mr. Levent Kutluka, Managing Director, Head of Fraud Risk Compliance at HSBC Hong Kong.
Thanks, and I'll echo the comments earlier about the importance of trade in taking, the movement of goods around the world. From a banker's perspective, we really like the self-liquidating and transactional nature of trade finance. The benefit of having very detailed insight into what's happening really gives us a much greater understanding of the transaction we're financing when you compare it to, say, more unstructured facilities. From a customer's perspective, these same attributes also allow for greater access to finance, which may not be available on an unstructured or unsecured basis. So that's the beauty of trade finance, and that's really why we like it. As mentioned earlier, fraud is one of the key risks that we have with trade finance, and we're really looking at trying to get much better in terms of managing that risk. My first experience with fraud happened when I was working in commodities trade, probably about 10, 15. And I just wanted to share some of, I guess, the key learnings that I had with that. It was a real eye-opening experience. And the first thing that really struck me more than anything else is just cognitive bias and how present cognitive bias is in the way that we make decisions as bankers. So probably one of the most common cognitive biases that we know is what we call confirmation bias. If you speak to anyone that property can only go up, if you speak to anyone that is long the share market, the share market bull run will never end. And we have a very similar kind of bias in the way that we do trade finance, where once we structure a facility, we grant limits, it's sometimes very difficult for us to change our position of where we were to think that we were wrong when we first made the decision. So that was really interesting. We also kind of have questions around the businesses, and what we tend to see with trade finance fraud is that there is always a core portion of the business that is genuine, and it's a core portion of the business that everyone in the economy can touch and see and actually experience. So it becomes quite hard to believe that there's something wrong with the company when you've just been to their store or you've just been and bought some of their products online, etc. Because what we're really seeing is that a portion of the business may not be genuine, and that's really where, again, that cognitive bias tends to keep ourselves as to whether we're right. I think one of the other key observations I had with that first experience of fraud is how important it is to have subject matter expertise in trade finance to structure facilities. A lot of the times where we offer trade finance facilities and we're completely dependent on the structure to come off to repay our facilities, we notice that the bank officers that are structuring the facilities may not have put them together, and there are gaps in the way that the risk is passing off. And whilst we might think that we're taking bank risk, we're actually taking, we don't quite understand the counter very well. And that's where a lot of these transactions break down. I'll get into some of that later on in my slide. The last one I wanted to talk about is just paying attention to detail and really focusing on stuff that doesn't make sense. And it was quite shocking to see that some of the key gaps in the stories being told in some of these trade finance cases, when you look at them with hindsight, they just don't make sense. And really, you need the courage to ask questions and just try and look into it more. And before I close on that point, I just want to pivot to the other side. It is very important to get in touch with your customer and ask for more information, particularly when things don't make sense. As much as I've found fraud, I've also found the vast majority of customers are good, genuine customers, and a lot of these indicators that we find can be discounted when we get into more detailed discussions with the customers, understanding what's happening, and then we're able to accept the transaction, and what we thought we saw is actually quite valid and explained away. Thanks.
Thank you for that, Levent. Our next panelist is Mr. Michael Hogan, Managing Director of Bonnet to Go. And again, thank you for being the sponsor of this event. Over to you, Michael.
It's a pleasure. Hi, can you hear me, Scott? Good, excellent. Hi, and good morning, good afternoon, good evening, everybody. I know we're dialing in from lots of different places around the globe, so thanks for joining. It's a pleasure to be here. And first things first, Scott, well done for getting so many, or three major trade bodies on one panel at the same time. I think that might be an industry first, but I think it also highlights the importance of the topic that we're talking about today. A little bit about myself. My name is Michael Hogan. I'm the Managing Director at Bonnet to Go here in London. I joined about 6 months ago, but I think I know many people on this call from over my 30 years in banking, 20 of which are in Asia, topped and tailed by 6 years each in EMEA. So I joined a minute ago, about 6 months ago. I'm not quite sure whether that makes me a poacher or a gamekeeper. I haven't quite worked that out yet, but I know that I'm still involved in trade and happy to be here. Thanks for putting the slide up there, Scott. Just a few opening comments from me, and I know we'll get into the questions later on, but in my time here within Monetigo, but also before that, fraud was one of those sticky issues which we couldn't really nail. I think we covered a lot of the risks within trade finance to good effect, but this was the one that always got away, and it's a bit of a many-headed beast as well. So let me share one slide only here, and I think Peter and Levent have covered some of the main fraud typologies that we've seen so far in trade, and Peter touched on the why these happen and how these can come around. Let me just dig into a few of those that we've seen here in Monetigo and show, you know, what they are and where we see them, what the impact of those are, and then what next. You know, what should we be doing next really to start addressing that, and we'll cover that later on. But let me just I'll take you through the slide. I'm not going to read through it. I'll just highlight some of the points here. So we mentioned there at the top, it's a global pervasive problem, and it is. It's not just an international problem, it's a multi-domestic problem in lots of many markets. Whichever markets we look at, there's variations on this. The main types that we see, having said that, are these three that I've listed there on the left. So they've both been touched on by both Peter and Levent earlier here. Fraudulent documents. You know, how do you know that documents that are being set in front of you to be financed as a trade financer are genuine? They're not fake documents, they haven't been tampered with, etc. And you know, we know trade is a very document heavy business, so who's got that sniff test and the smell test when they land on the table to say there's something wrong with these? The ones that arrive on Christmas Eve or New Year's Eve or Chinese New Year's Eve or Eid, all the various times when these come in quickly, you know, it's important to be able to identify and track these down. The second one, we talk about some of the duplicate financings. I'll come back to that one in a minute, actually, because the third one there is collateral fraud. So that's something which might be between you and your customer. The second one is then once you've established that these documents are okay, then they can actually still be financed across multiple parties. And the regulator, having solved one problem across the markets, which is customer confidentiality, has, I think, inadvertently created another, where it's stopped banks from sharing information. The fraudsters know this, and they're taking documents from one bank and shopping them around multiple banks to get multiple financings. And if you don't have a central registry of any sort in your market, then you're prone to this, or on a global basis indeed. Let me take you to the right-hand side of that, and you'll see we've got about 7 or 8 examples there as well of, let's say, fraud's greatest hits, if you want, but not in a very good way. And as you can see, there's probably 7 or 8 of those there. They add up to nearly $10 billion. Now, obviously, the companies that we've mentioned there's a lot of high-profile, high-value transactions. You know, many banks, and self included, would have been involved in these in some shape or form. And you can see across the right which of those have involved which typology on the left. So whether it's the fake documents, whether it's the collateral issues, or whether it's been the multiple financings. And sometimes it's 1, sometimes it's 2, sometimes it's all 3. The punchline to this is that they're quite high value in nature, and it's not the company that just loses these. Obviously, they go into liquidation, but the pain and the shock effects are felt quite far and wide. So the banks take these losses. So, you know, it's quite heavy duty. It's quite material in its impact. And we'd hope that over the years we'd learn from these, but even a couple this year, and there's 2 that I haven't listed on here, but just to highlight, we had a son of Qingdao. So for those that would have sort of heard of Qingdao before, which is the one at the top, that Dicheng Resources up there. There was another one a few months ago in China regarding or relating to aluminium shipments. And then there's more domestic ones closer to home. Some may be familiar with the Arena TV fraud scandal across the UK. So a company with £30 million turnover managed to create losses for banks amounting up to £300 million in total. That included fake invoices, non-existent collateral, and all financed multiple times across multiple banks. So what happens next? And I'll conclude shortly after this, but what happens next is when these things happen in banks, and having been involved in banks for 30 years, I know exactly what happens. The brakes go on. So the banks lose the money, lines are reduced, pricing goes up, and that pain is not felt equally across the board. It's generally the SMEs that take most of that because they can't shop around and get the facilities elsewhere. So many people have heard of the trade finance gap. That was 1.4 billion. Steve Beck is updating us regularly. It's 1.7, and now it's got to 2 trillion. Sorry, not billion, $2 trillion I see at the moment. So, you know, this is a pervasive issue which is ongoing and we need to sort out. A final point from my side as well, you know, in the document-driven environment that we have, it's very manual, it's very operationally intensive. Unless and until we move to a digitized environment, externally outside of the banks and internally within the banks, then it's going to be very difficult to crack these problems. So I think we do need to look at new approaches if we're really serious about fixing it. But good to be here today, Scott. That's my opening comments. Thank you.
Thanks for that, Michael. Much appreciated. We're going to move to our first audience poll. Oh, I'm sorry. Apologies. Next up is Mr. Andre Castleman, representing ITFA.
Thank you, Scott, for the invite, and thanks, Michael, also for the invite to this indeed possibly industry first session, as you mentioned. On my background, I've been in the fintech space for 30 years, 24 at Swift, and 6 in the more advanced fintech space, particularly focusing on trade finance and digital asset technologies. I like to say I never worked for a bank, but I always worked for all banks in my capacity for Swift, or now for my fintech clients, and working also with ITFA and ICC. So focusing on the industry trends and that are, I think, relevant for fraud, and how industry associations can help. I think we're moving into a world where I'd like to highlight two principles or concepts. Is a world that is far more transparent, and I'll come back on that, and where everything is far more accessible. Transparent is indeed supporting the fraud issue, whereby if anything is not transparent in the future, we're not there yet, of course, not everything is transparent, unfortunately, fraud is still very much possible, but as we progress, we see more and more technology solutions and policy also decisions that are making everything more transparent, and that will help indeed the insights that will enrich the insights that compliance teams and fraud prevention teams within banks and funders are operating. But also more and more with technology and with new user expectations, everything becomes more accessible. You don't need to lock information in order to make it only accessible to a set of people. Now with encryption technologies, actually you can make data far more accessible. And for instance, the public DLT, public digital ledger technology, is a way to make information far more accessible. But that doesn't mean everyone will be able to decipher the information, but only those people with the right keys will be able to access it. So I'm not here to promote the one or the other technology concept, but I think as many technologies progress and policies progress, transparency is increasing and accessibility to information is increasing. And we're seeing that with various initiatives that I'm involved in on the ITFA side with various of you in the audience. So how can industry associations help? First of all, I think it's important that industry associations support those developments in a neutral way. So we need to help the banks discover what are the technology options that the market is developing. And we have done that indeed on the ITFA FinTech side, whereby the educational objective was the priority a few years ago when we started in 2017-18, and making sure that the fintechs and the technology options are seen as future potential partners of banks. They are not competing head to head with the bank. Certainly in trade finance. In payments, it can be different, but in trade finance, definitely most of the technology innovations are really meant to become partners of banks. Then we basically identify the need for collaboration between various technologies, because the best technologies are those that integrate into the existing ecosystem. There's no need to change what is working, and back office systems, front ends, channels, a lot of investments have gone into those systems. There's no need to ignore those. And the best new innovations are the ones who can combine the strengths of the existing technologies and bring a very specialized and very focused value propositions to address a specific pain point, such as indeed fraud prevention. Then the collaboration has to expand, and it's more around engagement with policymakers, because sometimes the technology is hitting roadblocks because policies do prevent the adoption. Like, for instance, take electronic original documents in the MLETR context. If we don't change the laws, those electronic documents will never be adopted. So we need to change the laws. But by engaging with policymakers, we need to also to demonstrate what technology can bring, and to suggest them to also potentially mandate a new market practice. And this is where the industry associations, I think, bring the most of the value, is when they can really promote and push, as if they were the commercial organizations behind a new practice that will really help the market in a very scalable way. That doesn't mean they are promoting the one or the other technology provider, because that's more on the commercial side for the commercial private companies to develop themselves. But if market associations can convince policymakers that not only do we need to change the law to enable the technology to thrive, but we might need to mandate some new practices. And policymakers have been able to mandate many things on the compliance side, like regulatory reporting. But related to data sharing, if we see that there is a real value add in the market for mandating data sharing amongst funders on particular data sets, and that is basically the level where market associations and other stakeholders like WTO are really bringing the maximum value to the market, and without supporting the one or the other provider, because the commercial decision of the market to go for the one or the other technology solution is still, of course, in their hand. It's not the market association pushing that. So these are the levels of contributions that market associations can work on. And I think fraud is valid for all market associations, ICC, FCI, BAFT, ITFA, and I'm sure there are many more, certainly on the credit insurance side, that we can consider. So I think they're working on discovering the technologies and identifying where policy needs to change to make this technology really accessible, but also potentially mandatory in the future, is where what we need to focus on together.
Thank you, Andre. We now move to our audience poll, the first one. And I would also direct the audience to the upper right-hand part of your screen where it says polls, where there are the two polling questions available. And I want to thank you to the speakers for the first session. Now, if we could move to the poll question. Okay, if you would open up the polls on that right-hand box, the question is this: do you think industry associations should take a more active role to help members understand and manage fraud better? Your choices are: it's not needed, would help a little, but very useful, it is critical. Matt, are we able to see those results?
If you click on the tab on the right-hand side. So to answer your question, Scott, it looks like 54% say somewhat, but needs to be done. Needs to be done, excuse me. 42% says quite well done. And one person says totally under control.
Okay, so that was actually the poll for audience poll number one. which was, do you feel fraud and trade is well understood and well managed in your organization? So you said 54%, Matt.
So 31 folks have answered somewhat, but more needs to be done. 22 have answered quite well done, and now 3 have answered totally under control.
Well, I'd like to congratulate the 3 people that says it's totally under control. I think we could all learn from those individuals. I think the major point being taken here is that this is a moving target. And at the moment that our institutions think that they have a good handle on it, those creative forces, those evil geniuses on the other side of the table come up for ways to circumvent the best of controls that are put in place. So I think and one of the reasons why we really wanted to hold this webinar was just to put the highlight on where people can find sources of information and share information as to how to best address this ever-changing scenario that we face in terms of fraud. I'd like to now move to some questions to our panel, if I may. And the first of those questions is that it's clear fraud is an issue which still needs to be addressed. What's the impact on trade finance availability, and what's being done at an industry and bank level to stop it and spot it? Peter, do you have a feedback on that?
Yeah, certainly. I can maybe just touch first on the impact on availability, and that is definitive, and I think it's reflective of the 2 trillion. Of course, I thought it was 1.7 trillion, 2 trillion trade finance gap globally, and that's very simple. I mean, it's most of these companies that are not getting access are SMEs, and they're not getting access because of fear of fraud, fear of loss. From our perspective in the receivables finance industry, I mentioned before in the beginning of my presentation, it is so important to look at the pre-onboarding side, the data, looking at their sales, the dilution risk, the financials, the average DSO, just to get an understanding of their overall track record. And that leads you to an understanding of the client's behavior, and most importantly, the C in the 4 C's of credit, which is character, understanding the true character of the company. And you do that through very intensive investigation. This in part relies on 2 sources of data: internal data, so financials, for example, bank data, data on management, experience, etc., and external data that includes like credit reports, payment data, what we call a factor story, information on a client's factoring facility, bank story, a trade story. Why is that important? So we're looking for this data, and this data, as we all know, is mostly available in the developed countries and not in the developing countries. And this is an underlying issue for the industry at large. And I think I don't recall the exact source of that 2 trillion or 1.7 trillion gap, but I know a significant portion of that is in the emerging markets. And so it's important, and you asked the question now, what is needed? Yes, credit agencies, access to payment data to determine how a company pays, company identifiers that are being led by such initiatives as GLIFE, LEI, trade data from repositories, customs data, so data that you can touch and feel, and it's legitimate and real and rational. This data quantifies and then qualifies the onboarding process of the client and seller. Now, technology plays obviously a very significant and important role. The internet access is essential. Like, for example, I heard in this Afro-Exim conference here in Uganda today, everyone thinks that everybody has access to a phone and internet access. And the truth is only 25% of the population in Africa has access to the internet, to the Wi-Fi. And what that means, translated, small to medium-sized enterprises have also a very, let's say, reduced access to internet. And that's obviously a vital, critical source of data. And lastly, I'll just mention invoice verification. For our industry, this is probably the biggest important key. The verification of the invoice by contacting the buyer, the client's customer, is key. The biggest frauds in the receivable finance sector over the last decades has been under what we call non-notification programs. That means where the bank, financial institution factor cannot contact the buyer. They cannot verify whether the invoices are real. And in most of the cases that we have, and we have a large library of frauds. I always like to say FCI is a accumulation of 50 years of mistakes, our education. It's these type of transactions. So if you have access to the debtor, if you have access through notification programs, then you can basically rest assured that the buyer is acknowledging the legitimacy of the trade transaction and the legitimacy of the seller, unless there's collusion between the buyer and the seller. And we've seen that the biggest example is the Citibank Banamex case in Mexico, over 500 million, $500 million of losses. So there are many of things, and I won't get into yet because I think that's another question regarding what's being done at the industry bank level, and I'll address that a little later.
Levant, would you care to add to the comment?
Yeah, look, I think Peter's touched on the very key points here, and technology is key, particularly when it comes to receivables finance. And the more we can automate that whole process of which invoice has been paid, have they been received from the right counterparty, it just removes the manual nature of it and frees staff up to focus on where the key risks are. And that's ultimately where we're trying to get to. We're trying to make trade as frictionless as possible for all of the customers who are good. And the overwhelming majority of customers are good. And we need to always remember that as we do business. And that's the key. The key is the more data sources we have, the more technology we have, lets us focus on the bad and let the rest of the customers have a frictionless experience and grow and have access to greater credit lines.
Thanks, Levant. The second question we have is, we know detecting fraud in trade finance can be challenging. What are some of the controls to manage this risk? I'll direct that to you, Levant.
Thanks, Scott. All of this is basic. When I teach trade fraud, sometimes I go back to a book from 1898. It's a book by a guy, George Ray. The copyright's expired, so everyone can download it for free. And it's called A Country Banker. And it's a riveting book in the sense that some of the frauds in A Country Banker from 1898 are still happening in the year 2000 plus. The typology hasn't changed. It's always the same. There's just much more zeros on the end of it. And the key to finding and structuring trade and protecting your organization from trade really boils down to CDD. And the CDD, customer due diligence side of things, and customer selection is about understanding what your customer does. So if we take commodity traders, I know they've been very high profile lately. You really need to ask yourself, what is the USP of the customer? Even commodity traders should add value, whether they're aggregators and they're picking up goods from multiple suppliers and then aggregating them onto one vessel and getting some kind of shipping arbitrage, whether they've got other use cases. But ultimately, we should always be looking at who are the counterparties that they're trading with. Are they producers, end users? How does it all make sense for this picture to be put together? Looking at turnover, is it realistic that a company in Myanmar is turning over hundreds of millions of US dollars given where they are and the logistics of the business? Financial statements, Peter touched on a great point. The financial statements are a treasure trove of indicators that we can look at that at the very least give us pause and caution where we start to see indicators that are off. Trying to automate as much as possible these indicators to detect these and help get a more consistent outcome, because ultimately financial statement analysis at a very forensic level isn't something that most bankers have unless they've been trained in this type of work. So the more we can help our frontline colleagues who are structuring these transactions with that type of analysis is good. Trade structures, the looser the structure, the harder it is to detect fraud. Now, there's nothing wrong with a loose trade structure, and for certain customers, absolutely we can do that, but that's just the risk that you're taking, and then you take a risk-based approach based on your counterparty that you're dealing with. In terms of time structures, paying the supplier either directly or through an LC, always getting the export leg as much as possible, and seeing the end-to-end transaction, so you can see where the transaction starts, where the transaction completes, all the intermediaries. That's the key. Which brings me to my last point. So after we've onboarded the client and we've done all the due diligence, it's some form of transaction monitoring. It's absolutely essential that we keep monitoring the transactions to see if what we think we should be seeing is actually what we're seeing. Most businesses start out quite innocent. I said that in the opening comments, and you can start to see that gradual shift over time as the economic conditions get tight. Maybe they're trying to make another investment and they've drawn over financing to put some of the excess capital into a longer term capital fix. But over time, if you start to see that transaction pattern shifting into something that you didn't think was happening, or something that starts to look a little much more different than where you were, the earlier you can detect that shift, the earlier you can react and take action. Now that's where it gets really tricky, and this is something that was also touched upon. All of the transaction data and automating that is quite troublesome in trade finance, given that most of it is paper-based and most of it is fragmented, coming from multi-dimensions. And I'll stop there.
Michael, would you care to comment?
Yeah, really just to echo there and add a little bit more to what Levent has mentioned. I mean, the fraud controls in trade are really based around the trade practices in terms of the end-to-end operations, and whether we like it or not, they're intensely manual. They're paper-based, and they're sort of really from a world where, although I think the principles from George Ray's book apply, I think the way in which we do business, needs to change. And I think in terms of attempting to cut this out and cut the fraud out, the controls in place are pretty substantive. And I would say from the beginning, banks are not doing nothing. I mean, I've worked in banks where there's an immense amount of attention and focus on with specialized people to try and sort this out. What I would say is that the requirements are changing. So the requirements are getting tighter. So the regulators are now stepping up a little bit and upping the ante, if you want. And those in the UK, even not in the UK, but those who work for organizations who operate in the UK will have seen or received copies of the CEO letter, the Dear CEO letter, stating that, the game's moved. Know your customer, great, but now you need to know your customer's transactions. There's KYCT that we talk about, and you need to know the risks involved in those, and you need to know what controls to put in place on those. And then you need to verify and validate that you put those controls in on those as well. So, that bar has just got higher from a regulatory point of view. We're hearing similar noises from some of the other regulators as well, from a BAFT side as well. So I don't think the answer is throwing more people at it into an industry where, these doc checkers, I've mentioned the smell test before, that's for people who have got 30, 40 years checking documents in the back office. That's a world which won't be here tomorrow in the next 10 years. So as our environment changes, then so do the controls and the risks that we need to manage need to change as well. So I think there's a whole room for automation in here. And as that internal and external bank environment changes, we've got to grasp this so we can do it quicker, more reliably and easier. And I would take a leaf out of the PSD2 book. Very painful it was for many people who were involved in getting their organizations to PSD2. One, it liberated data for customer experience and for risk, and two, it helped that suspicious transaction monitoring that Levent mentioned there before. You've got to have people when you're doing high value commodities. Okay, it's high value, sort of low volume, and you can afford to throw people at it. But most banks have a big book of trade that they can't look at every transaction in as much detail as they'd like to. So we need to sort of move to the automation side there to really make this more effective going forward.
Following on to that, the next question that was posed is: trade is particularly exposed to fraud given high transaction values, manually intensive paper-based processes. Could the panel tell us more about some of the emerging technologies helping to strengthen existing fraud controls? So I'll pass that to you first, Mike.
Okay. Yeah. Thanks very much, Scott. Yeah, the way we, first and foremost, a single technology existing in isolation won't fix the problem. There needs to be a few things that really go with that. And we like to look at it in a couple of ways, really. One is there needs to be an environment and there needs in the market which enables that. So there needs to be standards in there as well. And we talked about them before, or Andre mentioned them before. There needs to be laws which underpin it. There needs to be standards which make it accessible and available and interoperable. And then there needs to be the solutions which sit on top of those. So we talked before about the laws, the legal side. So the MLETR law is critical, to allow what was physical documents to be done digitally and to allow those controls to be done digitally as well. The answer trial is very important too. The standards, ISO, that's really going to help. The APIs, API 3, the fact that those standards are out there too, they start facilitating these solutions in the market. And also then the digital environment. I noticed one of the questions which came through from somebody on the Q&A there was, they've noticed the Singapore registry. What else can be done in which environments to improve the way we manage these risks? And, India is a good example. India is a massive country, obviously, such a big economic powerhouse, but it's actually taken really good steps to start digitizing its environment. So if you want to be able to check whether somebody's got a VAT number or tax number, or whether an airway bill or a way bill has moved from A to B, you can tap into the government environment on a digital basis to prove that those things exist. So by almost a triangulation, if you've got a methodology of tapping into those, adding them up together, you can get greater confidence that that's a legitimate document in the first place that's required to be financed. And then the final part of that is, and I think as environments start to continue to do that and learn from each other, I think then we can really start to get some traction in managing this across a lot of our markets. The final point that I would mention here is on the solution side. KYC, absolutely critical. And a lot has been done by banks to improve the KYC. I think it was Andre or Levent that mentioned the Glyph stuff. That's KYC plus in my book. And I think that's a real good next step in the way we can actually identify clients on a very specific basis, in addition to what we've done before, at better quality and at faster speed. And then I'll just touch on some of the things that we've done, the KYCT, know your customers' transactions. So when these come in, how can you start to automate the way you look at these? And there's two things that we look at as well. One is authentication. And I've mentioned before how you can tap into golden sources in the market using APIs. So you can really do that at speed and before a transaction happens rather than 3 months after the transaction happens, because then it's too late and the money's in the hills and very far away. So authentication, being able to tap into those to prove in the first place that you have legitimate documents that you're being asked to finance. The collateral side we've talked about before. Obviously, if there's a central registry, that helps. If I want to get a mortgage in the UK, and it's just become a lot more difficult given what's happened in the market in the last week, there's a registry. People know that house exists. They know who's got the finance on it, and they know it's not being double mortgaged, if you want. We need more of those registries, advocacy to the regulators and to the central banks and to the governments to actually start establishing some of those. And then the final one that we have as well is it's the secure financing, where one of the problems I mentioned before is that banks are shackled with the issues of confidentiality. And we can't share the data that we have in our own organizations amongst others. So it's a great opportunity for fraudsters to shop these deals amongst banks, knowing that it's very, very difficult for the banks to actually share that. So introducing the technology that we've launched at the moment, which is encrypting, hashing, creating digital fingerprints into a confidential computing space, and then comparing that confidentially against others which go into that registry, is one of the only ways really at the moment where banks can cross-check against each other without releasing and falling foul to customer confidentiality issues. So there are a couple of solutions like that. When you add them up, there's no silver bullet for any one of them, but I think there's a window of fraud out there, and what we've got to do is create an environment and solutions which gradually close that window, so we can shut the guys out once and for all. But it will be dynamic, as you said before, but it just helps take us up to another level in terms of getting across this.
Thanks for that, Michael. Andre, would you care to comment?
Yes, definitely, Scott. Basically, I'd like to build on my objective to increase accessibility to data. And banks have a lot of internal data, but they have a technical challenge basically to link all those data sets together to get a holistic view on particular transactions and where risks can be located. So there are technologies to do that. It's really about managing data sets and correlating data sets and applying some AI algorithms on that. So there are solutions for that, but I think the challenge is mainly technical within the bank. But that's quite a small challenge. The other challenge is really to get closer to the data sources that the banking industry doesn't have access to today. So today banks, us as a banking industry, we don't operate the shipments. We don't have visibility on the actual logistics. And as Mike said, the MATR is important because that will bring bills of lading in an electronic way onto platforms, and hopefully we'll be able to get more instant validation of electronic bills of lading through those platforms that are emerging. So that track is quite developing well. But there is another way to basically avoid fraud, is by embedding the trade finance function into the logistics ecosystems. Because the logistics ecosystem, they operate shipments. They know exactly whether this shipment is existing and all the characteristics of the shipment, whether it's bulk or container shipment. And this is what some of the logistics players are starting to do. Because they own the data, and lenders, banks, non-bank financial institutions, wishing to indeed finance SMEs, can trust this data, because this data is representing the real logistic transaction, the real trade transaction, not the trade finance transaction, the trade transaction. So by getting closer, by getting the trade finance function closer and possibly embedded into the logistics process, we basically avoid or we basically can tap into trusted data sources. But we need to go outside of the banking system, because the banking system is not basically managing this data. It can only hope to have increased access to this data. And of course, the key is to work with trusted companies that are established in the market on the logistics side. There is one player I want to highlight, because within ITFA we're working quite closely with them, and I think that's a model that is quite credible. This is GP World based in Dubai, but operating across the globe, quite a large organization. And basically they are combining their role as a huge, I think they operate 16% of global trade, physical flows, and basically they are expanding their offering with Cargo ES into the trade finance function in partnership with banks, basically, but to combine the balance sheet capacity and risk appetite of the banking industry that we operate in with their position in the logistics industry. And this is how we can combine the best of both worlds, trusted data sets with the funding appetite.
Thanks for that, Andre. We have one more question here before we kind of hit the witching hour. Are industry bodies doing enough to fix fraud? What's been done and what needs to be done going forward? Andre, I'm going to put that to you first.
Yeah, and definitely on my scale of the various steps I highlighted earlier, and I can write a blog about this for later or develop a slide. But definitely we have done the minimum. That is certainly on the ITFA FinTech committee's side, which I chair. Fraud has not been a topic so far, so I plead guilty here. But still, Moneta Go being an ITFA member, we have highlighted that they are a partner to the banking system and that they have a solution. So we have reached the discover phase, but we could do more, like and do more by engaging with regulators and developing the tech agnostic market practice and demonstrating both to the banks and to the stakeholders on the policy side that we need to change the way we operate in order to increase indeed transparency, to increase accessibility to trusted data sources, and to make sure data sharing is not only allowed, but for some data sets, and I'm not the expert that will describe this in detail, but for some data sets to be shared on a mandatory basis. In the same way as Mike said, PSD2 has been mandated, and that has been a good thing for the end customer. I think if we want to tackle the fraud side, we won't do it on the back of just willingness from banks. the top banks might be keen to do more, but the bulk of the market, the smaller banks, might not care so much about it. So we need to make something much more mandatory, much more structured and organized, working definitely in partnership with the policymakers. And we're going to create a new market, indeed, for registries or for other types of capabilities. Data sharing, AI is a very strong proposition. But I think the key to unlock here is the banks working with trade associations, and trade associations, together with the banks, of course, approaching the policymakers on how to tackle this collaboratively, and inventing new regulations in this market.
Peter, your view.
Yeah. Again, thank you for the opportunity. Sorry I jumped off, but we had a power surge here. So I would just say that combining what Andre and Michael said. I'm sorry, Levon, I didn't hear what you said earlier because I was kicked off. But legal. I mean, the associations and the industry bodies can help support the development of very, very strong civil and common law infrastructure to create and instill confidence for banks, non-banks, entrepreneurs, industrials that do supply chain or receivables finance in any form or fashion, but also criminal law. Strengthening criminal law relating to penalizing the fraudster. I remember when we wrote a book on the 2,000 plus year history of our industry, and the debtor prisons were the thing back in the day. If you didn't pay your bills, you went to debtor's prison. So maybe we should blow the dust off of the debtor's prison concept. The other, of course, is what Michael talked about and elaborated on, and that's the formation and creation of the receivables registry. And no greater example is that which is in the U.S. Under the Uniform Commercial Code. It is the beacon, the great example of how to do a receivables registry right, creating priority, creating liens or for assignments or purchases, knowing your priority, your position, and ensuring there's no double invoicing. Double financing. This system was established initially in the 1940s. This was 50 years before the age of the internet. So, in this modern age, for the ability of a company like Monetico to come in, help strengthen the receivables regime in a particular country is a wonderful thing and something that can happen very quickly. The last two things I'll mention is one I mentioned earlier is the creation of a payment repository. So use the example of Africa, where it's so difficult to get payment or data in general to make a underwriting decision on a buyer, for example, or for a client, knowing their credit worthiness. And especially if it's an SME. So if you can then accumulate all of the payment data that every buyer, purchaser of product or service in Africa through credit insurers, banks, non-banks, through factors, of course, et cetera, you could accumulate this data and use this data. Anybody sharing it can then use the data of the other. And this is what we are creating in Africa, and we're hoping to use this as a beacon going forward in other markets. And this is being inspired as well by the African Export-Import Bank. And I'll just lastly close by saying technology. It is the backbone, and Levon, I'm sure you can talk about this for ages. It is the backbone of any financial institution, any type of company that is investing in the space of receivables, because the system is the only platform whereby you can determine debtor concentrations, irregular receivables activities, irregular payment activities, payments coming from third parties, dilution, debtors' overall inability to pay, and ultimately to determine what's considered eligible and ineligible receivables availability. And then banks or financial institutions, factors in general, need to keep a very close eye in the post-onboarding process of monitoring the receivables portfolio. And a good system will do this and show you any red flag, any kind of unusual behavior that occurs. I will just close by saying, FCI has every single major software technology company that's doing anything in the receivables space as a member of our organization. And trust me, this is one of the most important avenues that we promote. And I have to say, especially in emerging countries, where we advocate and ensure and support this evolution of onboarding. And last, FCI itself has a system, both traditional and reverse, that allows companies, members to use for cross-border activity to reduce the exposure, to reduce the risk, but also to verify the invoice. You know, if you're working in where I am in Ghana and you're shipping to a company in South Africa, you can go and get verification of invoices from the huge factoring community that exists in South Africa today, as an example. That's it. Thank you very much.
Yeah, thank you all for your comments. And just a brief aside for BAFT, our operations are basically divided into trade and payments. On the trade side, we have a very active compliance committee who is involved in looking at a full range of issues regarding both fraud as it affects trade. We've recently put pen to paper in terms of our working committee group putting together a paper on maritime compliance, which we hope to release fairly shortly. My newly joined colleague, Deepa Sinha, has put together 2 new committees on the payment side, and they're both, one is on trade-based money laundering, and the second is on financial fraud. So we are an association, we're member-driven, and this is always a key element of them in terms of their participation in BAFT. Our role then is to take what the members are looking for and then take on a role of advocacy. As people said, none of this happens overnight. It's really kind of a hard slog in terms of interface with the regulators. But it's very important for us to be out as industry groups, to be out in front of where the regulators are, because a lot of our role is education and having the regulators understand the knock-on effects or untoward consequences of regulation that might come in without understanding what the end effect is going to be. This kind of brings the, I guess, do we have time for one more poll, audience poll? Okay, let's look at this last one then.
I have the results, Scott, so I will read these ones, the correct
Okay.
polls. This is, do you think industry associations should take a more active role to help members understand and manage fraud better? So 49%, 35 folks said would be very useful. 43%, 31 folks said it is critical, and 7%, 5 folks said would help a little.
Okay, thanks for that. We're gonna wrap up here, but I'm gonna ask each of the panelists just to take maybe 30 seconds and say, what one thing would you leave the audience today? Maybe start with you, Michael.
Sure. Well, it'll be less than 30 seconds, but more than one. Don't wait to be mandated. I know how painful that can be. And, you know, getting wrongly mandated for something which may not have the desired effect is really painful. So let's help each other to help ourselves, and, you know, join these industry bodies and get it up from a bank level to an industry level conversation. And I think that will definitely help, you know, whether it's across the different organizations or whether it's together, that will definitely help. And, you know, there are people joining into an ICC white paper, etc., which is being released over the coming weeks. Do this, and I think join in, because it's a sensitive issue, but it's much better to solve that together than to try and do it individually.
Andre?
Yeah, I would recommend to open up new technologies at bank level in this case, indeed, and focus on the ones that are really highly specialized. I've seen over the years, not only with my clients, but with a network of about 60, 70 fintechs that I'm tracking in the fintech committee of ITFA. The specialization is the key to success. So, whether we're talking about indeed correlating data through data management technologies or engaging with third parties to source trusted data sets from those logistics operators. There are various ways to achieve this, but focus on discovering those technologies and trying to map those to your short-term strategies.
Thanks, Andre. Levant, your thoughts.
Yeah, I think one of the points that we haven't touched on, I know we've spoken a lot about digitization, is also about culture. I think there's always been this stigma about fraud and trying to get an organizational culture that's quite happy to talk about this, much like we do about credit risk, is probably one of the key areas that I think I saw some of the Q&A, and it's a fair comment. We don't all have budgets to do AI and automation. That's 100% true. So some of the stuff you can do without AI and automation is really around cultural change and trying to get this cognitive bias broken down such that if someone does make a mistake, or I wouldn't even call it a mistake, when we onboarded the client, they looked a certain way, the risks looked a certain way, and over time they've morphed. And now we see the picture differently, that we accept as an organization that this is the risk that we do, and then come up with processes, procedures, and culture that accepts this and lets us wind back our position in an orderly way.
Thank you. And Peter, to you.
Thanks, Scott. Yeah, well, the truth is, in this hyperinflationary environment, a huge increase, obviously, in interest rates. There's always been this fear during and after the pandemic that we would see one of the legs of the stool fall out. And I can pretty much guarantee you that of our 400 members that account for nearly 2/3 of the global industry, there are frauds in their portfolios today. And it's happening right now as we speak. And the truth is that I think people are, in a way, fat and happy, as the old saying goes. They're not preparing themselves for this worst case scenario. And it's happening. And we're sounding the alarm bells. I don't mean to be overreactive. And on the flip side, this is the golden era. I mean, our industry has never grown so fast, probably in the history, certainly in the last 50 years. 15% last year, another 20% year to date globally. It's astronomical growth. But the fraudsters are there. They're preparing, and they're gaining steam. So yeah, I would just really caution to the wind, so to speak.
Before we wrap up here, I want to remind our audience that there'll be like roundtable discussions. Our experts will be at tables 1, 2, and 7. Hopefully, some of the Q&A questions have been answered. If they're not at this session, we'll distribute it to our panelists and get back to you with those questions. So I'd really like to thank Levant, Peter, Andre, and a special thanks to Michael Hogan and Montego to being the official sponsor of this event. So again, thanks a lot. And we'll now close the formal session and move to the roundtables. So thank you, everyone.
Thank you. Thank you, Scott.
Thank you.